So good afternoon. Let's go ahead and get started. My name is Alvaro Meza, and I'm an economist at the Federal Reserve Board. Welcome to today's financial literacy seminar. We're very pleased to host today Hwa Seok, a colleague and a senior economist at the board. Hwa Seok's research interests include household finance, consumer behavior, and bank regulation, and she earned a PhD in applied economics from Cornell University. Today, Yang will present her work titled Inferring Financial Sophistication, Evidence Using Credit Card Balance Transfers and the Card Act. Just a few housekeeping notes. Please put any questions that you have into the Q&A box, not the chat window, and I'll moderate those questions over the talk. Probably I will just interrupt the talk to cover clarifying questions and leave the rest to the end of the talk, but feel free to send any type of questions at any point. So with that, I will turn it over to Hwa. Thank you very much, and the floor is yours.
Thank you for having me here. I'm very excited to present this paper at the seminar. Let me share my screen. Can you see my screen?
Yes.
Yes.
So today I'm going to present Inferring Financial Sophistication, Evidence Using Credit Card Balance Transfer and the Card Act. So this paper is co-authored with James Wang from the Federal Reserve Board. So before I begin, I must say that the views expressed here are on my own and does not reflect the views of the Board of Governors. So in this paper, my co-author and I measure how financial literacy influences consumer choice. So our former chairman, Ben Bernanke, once said that well-informed consumers are one of the best line of defense against financial products that are costly or abusive. So financial knowledge is becoming more important for several reasons. New technologies and service models increase complexity of consumer finance. So it can be challenging for some consumers to understand details of these products if they don't have sufficient financial knowledge. In worst case, these products may incur additional costs to consumers if not used carefully. So financial knowledge can help individuals make informed decisions and feel confident about their decisions when they use these products. When properly used, it can help reduce borrowing costs and introduce new opportunities to save. So it is important to measure and understand the impact of financial sophistication. But then what is financial literacy or sophistication? So it is difficult to define and measure financial literacy. But thanks to the effort this center has contributed for the last 10 years, and researchers who studied financial literacy, we have a better understanding of financial literacy. For example, Luzardi et al. 2009 draws a distinction between literacy and sophistication. So in the paper, the former is defined as basic understanding of fundamental economic concepts, whereas the latter is related to more advanced understanding of financial topics in addition to financial literacy. So common tests to measure financial literacy includes survey questions on how consumers understand essential aspects of annual fees, interest rates, diversification, or capital market. So in our study, we focus on one particular form of financial sophistication, whether consumers commit credit card maneuver, which requires a complex understanding of credit card rules. Because we are looking at a particular form of financial sophistication, we don't differentiate financial literacy from sophistication, so we use both interchangeably. So what we do in this paper is that we develop an observed measure of a financial literacy based on actual credit card usage using loan-level regulatory credit card data. So we were particularly interested in credit card behaviors, whether behaviors tell us anything about consumers' level of financial sophistication and their understanding of credit card rules. And we find that the financially less sophisticated have more delinquency and default risk. They are more likely to pay unnecessary fees and pay larger finance charges. And when credit card companies solicit balance transfer, their cost of borrowing and loan terms were not different from sophisticated. So this suggests that this form of sophistication is not initially priced by credit card companies. And the Card Act reduced the cost of being unsophisticated and reduced their interest payments. But people who do not have a good understanding of credit card features also make poor use of other loan products, such as auto, home, and personal loans. Also, the area with a large share of financially less sophisticated is correlated with local education and unemployment rates. So our work contributes to the field of consumer finance, mainly financial literacy, credit card behaviors, and Card Act. So in the essence of time, I'll briefly mention literatures that are more related to our research. So literatures on financial literacy use various tools to measure financial sophistication. The seminar paper by Luzardi and Michel created a survey that tests basic economic concepts such as compounding interest rates, inflation, diversification to identify consumers' level of financial sophistication. And they find that financial illiteracy is widespread across countries in all ages and also correlates with education level in the United States. Among credit card papers, a related paper is by Ponce et al., who find that consumers are not price sensitive when they allocate their debts. So in the paper, they observe that consumers allocate a large portion of debts to high interest credit cards, even if they can substitute this to lower interest credit cards. And they suggest limited attention can be a reason because consumers are not paying close attention to interest rates when they use credit cards. And among papers related to the Card Act, Egawar et al. Find that Card Act reduced borrowing costs for using credit cards because Card Act restricted the credit card fees. So in our paper, we also find that Card Act reduced interest expense by approximately $120 for less sophisticated users. So we are one of a few papers that investigate the impact of the Card Act's payment allocation rules on consumer credit. So going forward, I'm going to talk about the background and then empirical methodology and then effects of financial literacy and conclusion. So in this paper, we are interested in a specific credit card maneuver, whether this credit card maneuver tells anything about consumers' level of financial sophistication. And for this, we look at consumers' balance transfer activities. Then what is balance transfer? So in this slide, I want to briefly overview what balance transfer is for those not familiar with this service. So balance transfer is basically a service that allows consumers to transfer multiple debts, including credit cards or other loans, such as auto, students, small business, and home loans, to a credit line. So you pay balance transfer fee, which is in general 2 to 3% of transfer amount. And consumers who have an excellent credit score get a 0% teaser rate when they open a new balance transfer account. So why do people use balance transfers? So there are several benefits. Consumers can consolidate multiple debts from different financial companies into a single revolving credit line. So it's more convenient to manage when you have multiple debts to pay each month. And the greater benefit is people can save interest expense. So balance transfer offer generally come with a promotional interest rates, so people can save interest expense by transferring high interest debts to low interest credit cards. So this is what you typically get for a balance transfer offer. So in the flyer, the credit card companies offer interest-free rates for about a year. Fee is about 2.5% of the transferred amount. And after promotion period, interest on transfer account increased to 3 to 6%, depending on the type of credit cards. And APR for purchase is much higher at about 12% to 14%. And interest-free period is on average 12 to 18 months. So balance transfer gives consumers more opportunities to save interest expense. But there are some caveats. So consumers must transfer debts within a promotional period to get a teaser rate. So if consumers transfer existing debts to a balance transfer account within a promotional period, say 2 to 4 months after they open a new account, 0% teaser rate will be applied to these balances. But if the user used the same credit cards for purchase or transfer the balances after the promotion period, regular interest rate will be applied for that transaction. So depending on how and when you use these balance transfer credit cards, you can get mixed balances with the different interest rates on the same credit cards. So in 2009, regulators implemented the Card Act to create a set of enhanced consumer protection, disclosure, and prohibition status into the credit card market. So before the Card Act, credit card companies allocated the order of payments in a most profitable way. So when consumers have a mixed balances with low and high interest rates, credit card companies charged off low interest yielding balances first. So in this example, they charge off 0% interest balances at the end of month 1. And at month 2, they charge off another 0 interest balances again, so that high interest yielding balances stay longer in the accounts and consumers pay more interest expense. So in pre-Card Act, sophisticated way of using balance transfer is once you transfer balances, you do not touch this balance transfer account until the end of a promotional period. If you must use your credit card for additional spending, you use different credit card and split spending. That way, you can control your credit card payments and make the most of interest-free benefits. So good strategy here is at the end of month 1, you pay high interest yielding balances first, and you do the same thing at month 2. And then you move to lower interest yielding balances so that lower cost balances stay longer in the accounts and you pay 0 interest fees for these balances. But with the Card Act, none of this strategy matters because when consumers have mixed balances with high and low interest rates, regulators required credit card companies to charge off high interest yielding balances first. So balances that were transferred during the promotional period will be paid off only after regular APR balances are depleted. So post-Card Act, consumers don't need to come up with their own solutions to save interest expense. So in this paper, we used the loan level data from Y14M regulatory report from the Federal Reserve. So Y14M has loan level collection from 2008 to 2022. And our sample covers period around the Card Act, so it covers 2008 to 2011. And Y14M is monthly frequency data from large bank holding companies. It represents about 80% of the entire US credit card market. And this data has many useful information, including promotional balances, balance transfer amount, interest rates, cycle ending balances, and delinquency status. And to the best of our knowledge, we are one of the first to use these promotional balances in the Y14M to identify how consumers use balance transfers. So we are also able to identify whether account has more than one credit card at the same bank. So to be included in the sample, account must have more than one credit card and have a balance transfer activities. So accounts in our sample are all able to separate purchase onto another credit card. We also use American Economic Survey data to measure the relationship between financial sophistication and social and economic characteristics like unemployment rate and college graduation. Lastly, we use the consumer credit panel data to check whether there are spillovers to other loans. So another contribution of this paper is we created this novel data set by matching regulatory credit card data with the Economist consumer credit panels. So the Card Act was introduced in January 2009, signed into law in May 2009. So the major amendments, including the payment rules, took place in February 2010. But credit card companies had the option to begin implementing changes prior to that. And we defined the pre-Card Act period to be 2008 because Y14M starts from 2008. And post-Card Act period is 2010 to 2011, and we excluded 2009 from the sample. So to recap the background, so there are basically two key takeaways. The first one is prior to the Card Act, sophisticated way of using balance transfer is to use different credit cards and split spending for additional purchase. But in post-Card Act, no such strategy is necessary. So we defined a commingle to be accounts that continue to purchase using the same credit cards while there is a promotional balances with a lower interest rates. And we defined separating as people who do not commingle and use different credit cards for purchase. So in our study, whether consumers are split spending or not is an important indicator when we measure financial literacy. So before the Card Act, some people split spending because they are sophisticated about the credit card features. And some people do not split spending or commingling because they are less knowledgeable about balance transfer rules. But it can be naive comparison if we just compare those that commingle with those that separate, because besides financial sophistication, there may be other factors that endogenously affect consumer strategy. For example, people may use the same credit card because it's more convenient to use one credit card rather than carrying many credit cards. Hyperbolic discounting can be another reason, or reasons like short attention span bias that may affect people who have trouble paying attention to small details of important credit card information. Liquidity constraint can be another factor. So it can be the case that some consumers have only one credit card and therefore they don't have any other options but to use the same credit card despite higher interest charges. But in our study, we only include the cardholders with more than one credit card, so we control these liquidity constraints. We also control many time-varying credit card characteristics, such as credit scores, limits, utilization rates, and interest rates. So conditional on these controls, we rely on the assumption that the Card Act changes the propensity for the sophisticated to commingle, but does not affect other factors. So for example, so conditional on the loan terms, if the borrower commingled mainly because of convenience prior to the Card Act, it will continue to do so after the Card Act. So for empirical strategy, we restrict our data to cardholders with multiple credit cards. Promotional balance must have lower interest rates than their regular purchase rates. When there are multiple balance transfer activities, we restrict each account to their first instance of balance transfer. In pre-Card Act, sophisticated users switch to another credit card and separate their spending, whereas unsophisticated users use the same credit cards for purchase and end up paying higher interest charges. So before the Card Act, we can distinguish whether a person has a good credit card sophistication by looking at their behaviors. So people may decide to commingle because they're unsophisticated about the payment rules, or because of other reasons like convenience, personal preference, or short attention span bias. Similarly, people can separate their spending because they are sophisticated about the payment rules or due to other unobserved factors. But post-Card Act, people are not penalized by their behaviors. So there's no sophisticated way of using balance transfer, and we cannot really distinguish the level of sophistication by observing their balance transfer behaviors. So we use a quasi-diff and diff to measure the impact of sophistication on outcome variables. So although we use diff and diff across the Card Act, please note that the Card Act is not a treatment effect for financial literacy. The treatment in our model is consumers' decisions on not separating balance and transfer accounts or commingling before the Card Act. So the beta captures idiosyncratic behaviors of people who stick to one credit card for additional spending. And pre-Card Act indicates whether the first balance transfer happened before 2009 when the Card Act was implemented. So data here captures behaviors of people who commit balance transfer in pre-Card Act. The delta is the parameter of interest, which captures the behaviors of people who continue using the same credit cards before the card act. So this is a summary stat at the point of balance transfer in the Y14M. So observations are evenly split between pre and post card act. About 748,000 observations are from people who continue using the same credit cards. And among these people, more than half of observations commingled in pre-card act. So these are the people who we defined as unsophisticated users. Average credit score is about 738, which is pretty high compared to the average for general credit card users. So balance transfer is highly concentrated among prime credit score users. Balance transfer volume is about 5,500, which is very close to the average promotional balances. So people use balance transfer account to save interest expense. So this slide shows average days past due since the balance transfer. So blue line indicates consumers who separate balance transfer from regular purchase, and red line indicates people who do not separate. And we also differentiate the graph by different timelines. So the solid line indicates pre-card act, and dashed line indicates post-card act. And red solid line shows the behaviors of people who we defined as financially less sophisticated. So if you look at the graph, average days past due increased for 4 groups after balance transfer. The solid line, which indicates pre-card act, is higher than the dashed line because financial crisis affected the pre-card act period. And the difference between red and blue may come from idiosyncratic factors like convenience or any other unobserved factors. What's interesting in this graph is that the gap between A and B in pre-card act is much larger than the gap between C and D in post-card act. So other than idiosyncratic factors, we believe this is due to the credit card sophistication. So as people in line A are less knowledgeable about credit card features, they spend more interest expense, which consequently increase their cycle ending balances and create more days past due. So we estimated delta using different outcome variables. And the table shows the effects on days past due from 3 to 24 months since the account was first observed. So in this analysis, we control many credit card characteristics such as credit limits, balances, APR, FICO score, income, and total fees. So coefficients on the interaction term starts low and is not significant in 3 months after the account was first appeared in the data, but then it gradually increased as time passes. And after 2 years,
can I ask you a question? A clarifying question. Can you hear me?
Yes, I can hear you.
Oh, okay. So we got a question asking if this is panel data, if you see the same people before and after the credit card act, and also are you worried the credit transfer terms and who it is offered to change after the passage of the card act?
So it's a panel data, so we can track down the balances and the transaction of the people. But then credit card terms, so when we are looking at the start of the balance transfers, which happened before the card act or after the card act. So so if the person commits a balance transfer before the card act, the person is counted only once. The after card act, the person does not count it after the card act. So the card act does not affect the credit card terms for those people. So this shows the progression of the coefficients on the interaction terms at different time horizon. So the pattern steadily increased for days past due until 24 months. And 1 year after the account was first appeared in the data, people who are less sophisticated are more likely to pay late fees. And they pay about $12 more on the monthly finance charges. and they are also more likely to pay over the limit fees. So we know that less sophisticated users are becoming riskier as their account age. So we checked whether this risk had been considered by credit card companies when they saw these balance transfers. So we ran the same regression, but restricted the time to a period when the first balance transfer activity was observed. And we find that less sophisticated consumers do not have significantly different interest rates, credit limits, credit scores, or income at the moment when they start balance transfer. So this tells us that at the point of balance transfer, those that commingle and separate have a similar loan terms, and much of this potential delinquency risk that are coming from financial sophistication are not priced into initial credit card terms. But credit card companies adjust their pricing as they observe this increased delinquency risk. So after 1 year, annual percentage rate is about 20 basis points higher for unsophisticated users. And this is not because less sophisticated users had a higher APR from the beginning, but it's rather the consequence of more days past due and high finance charges that they pay for interest expense. And credit limits and credit score also decline as delinquency risk increase in all groups. So we find that less sophisticated consumers have more days past due and pay more late fees. And despite this risk, credit card companies do not consider this form of sophistication when they solicit balance transfers. But they start adjusting the price of using credit cards as they see this increased risk, which is reflected in higher APR and decreasing credit limits. So we used the card act for our identification strategy, but we also wanted to know whether the card act actually helped the consumer to save interest expense. So we used the new payment allocation rules and did a back of the envelope calculation to check how much consumers could have saved had they have card act rules in place in 2008. So for the analysis, we assumed the payments before the card act is unchanged, and we applied the regular APR to non-promotional balances and promotional rate to the balances that are under promotion. And because we only have the promotional balance information, but not the actual promotional APR at the sample period, we assumed the promotional APR to be a third of a regular APR. And we find that the card act actually helped the consumers save interest expense by approximately $120 on average. The finance charge, actual finance charge in pre-card act was $334 for sophisticated users and $565 for less sophisticated users. But if we apply the new payment rules, finance charge becomes $347 for the sophisticated users, which is close to the actual number. So this imputed finance charge for the sophisticated users should be close to this actual number because the card act does not change how much sophisticated users pay their finance charges. But imputed finance charge for the less sophisticated users decreased to $445. So this $120 difference represents the average savings that less sophisticated users could gain annually if the card act were active this time. So this $120 saving can be seen relatively small, but the overall cost of being unsophisticated will be much larger if we consider additional late fees due to delinquencies and effects on credit scores or credit limits. And also we are only looking at impacts for balance transfer users who in general have a good credit scores. But if we consider more general population, economic significance can be much larger. So we know that less sophisticated use of balance transfer causes more delays in credit card payments, more late fees, more interest charges, and it also affects credit scores and credit limits. So my co-author and I were curious whether this impact is limited to credit card activities or whether it also creates inefficiencies in other financial activities. So we used the Economist consumer credit panel data to check whether there are spillovers to other loan products. So CCP is 5% representative. It's a semi-annual snapshot of random subset of borrowers. So it contains entire credit files and histories of auto, credit card, home, and student loans. And to match CCP data with the Y14M data, we applied exact match on zip code and period, and fuzzy match on credit limits, balances, and credit scores. The first 4 columns show the result for delinquency risk in credit cards, auto loans, and student loans and mortgage. So with the exception for student loans, consumers who use balance transfer in a less sophisticated way are riskier in other lending products. They are more likely to be delinquent in auto loans and also more on the mortgage, and have a longer auto loan terms, more credit inquiries, more chances of bankruptcies, and more chances of using personal loan lender, which tend to offer high interest rates. So those who are less sophisticated about credit card rules make poor use of credit cards. And this does not stop at credit cards. They also experience difficulties in using other financial products and spend more on finance charges when they use other loan products. But should this be just a problem of individuals? And how does financial sophistication affect local economy? So in the next analysis, we further measure whether financial sophistication correlates with the local area characteristics, such as college graduation rates, unemployment rates, and local average income. And for the analysis, we use a zip code level data from 2011 American Community Survey. So to look at the impact at the geographical level, we aggregated the Y14M data at the zip code level and calculate the proportion of card balances that are from people who commingle pre and post card debt. The ratio greater than 1 indicates larger proportion of less sophisticated individuals in the region. And we are able to calculate the sophistication level in many counties, and we see these significant regional variations across counties. And the results show that areas with a low level of financial literacy correlates with higher unemployment rates, smaller share of employers from finance and business sector, and low college graduation rates. So in conclusion, we find that people who are financially less sophisticated are more likely delinquent and default on their credit cards, are more likely to pay unnecessary fees and pay large finance charges. However, when credit card companies solicit balance transfer, this form of financial sophistication is not considered, and cost of borrowing and loan terms were similar between sophisticated and unsophisticated users. We also find that regulations that aim to help consumers reduce credit card interest payments, but other costs still remains. So for example, we find that unsophisticated users also have difficulties in using other financial products, such as auto, home, and personal loans. And at the aggregate level, it also affects local economy by affecting local education level and unemployment rates. And since the local education and unemployment rates can be a predictor of financial literacy, more financial education in this area can be a good idea. But overall, these findings suggest that financial sophistication for credit card transfer, balance transfer is not domain specific, but it has a more broad and significant impact on our daily financial activities and local economy. And because financial literacy can help consumers understand financial products they purchase and reduce these inefficiencies, it is very important to promote financial education and have more researchers in this field. And I think this is why the mission of this center is so critical. And I look forward to more events like this and thank you again for the opportunity to present our paper, and I'm willing to answer any questions if there are any.
Yes, thank you very much, Hwa. So one question would be, why do you think, did you have a story, a possible story for why we see effects on all other debts, but not for student loans?
So, okay, let me go back to, that is a good question. So, so student loan tends to be more forgiving loans. So you have grace period and government guarantee sort of the loans. So that's another reason that we see less default in this type of the loans. And another thing is that we don't have as much observations as we see in other loans, and maybe that's another reason. But I think the major reason that we don't see increased delinquency in student loan is because the type of the loan is a little different from other loans like auto loans and credit cards and mortgages. It's more like forgiving, and it's more like grace period, and you can defer payments on the student loans as well. And that's another reason why we don't see increased delinquency and default risk in this loan.
Great. So another one would be about heterogeneity. Who is more likely to commingle versus not? And for example, do you observe some demographics like young versus older people? I don't know if you observe gender in the Y14, so something that could talk to heterogeneity.
So unfortunately, we don't have individual demographic information like age or education level. That would be another area that we want to look at. So, but then one thing to note is that the impact was more severe among subprime users than the prime users. So here, so for example, in terms of the late payments, we see like on average, people are late on payments for like 2 days, but for subprime users, they're like 30 days more late on payments. So that's the impact was more significant among subprime users. So that's one thing we wanted to note. But then unfortunately, we cannot distinguish whether the accounts is for male or female, or any other like education level. Yeah, so other than credit card transaction information, it's not possible. But maybe we can use like CCP data. We can match based on the similar attributes and see if so CCP data has that kind of information. Maybe we can work on that part as well.
Yeah, probably you can look at least age on the CCP, because there you're going to observe. So, and then one technical question: how's the match? That's a very interesting thing. The Y14 with the CCP. Do you do a good job there matching? Do you think?
So I think we have about like 1.5 million accounts in the Y14M, about like 82,000 match on that. So it's pretty significant, and we also see some significant, statistically significant result here as well. So I think that's so we were able to find out the accounts that share similar attributes, such as like same dates, similar credit scores, similar level of spending, and all that. So I think that worked pretty well. So yeah,
that's good. And one that is like a broader question. What are some of the policy implications? What else can we do to help people manage their credit cards?
Yeah, so I think one thing for sure is we need to make credit card rules more transparent, for sure, so that it's for everyone, not just for people who are very good at understanding credit card terms. So it should be more transparent, for sure. And another thing I think we can do about is we can make maybe it's like in general, like financial illiteracy is more like disproportionately affect older people, minorities, low income individuals, and individuals like without college degree. So, and they have this smaller financial cushions and have less ability to find alternative solutions. So what we can think about is we can think about ways to promote like some kind of like consulting services for those people, or like provide like subsidizing for expert services for these people, so that they have a chance to compare cost and benefits with an expert. And that's another thing we can consider. And another thing we can consider is we can provide more financial education to young students, so that they are fully financially knowledgeable about the product they purchase before they make important decisions, when they like buying houses or things like that. So.
No, that's good. Another question is, could you use some information at the state level, for example, to get some other measures for being liquidity constrained?
State level? Are you talking about this this analysis, or? So for liquidity constraints, one thing we focused on is we wanted to only include the cardholders who have more than one credit card, so that they have an option to use other credit cards when the person has promotional balances in another credit card balances. So that's one thing we controlled for liquidity constraints. And we also control for utilization rates, which also tells about how much person use the credit cards. So that's something we control for the liquidity constraints.
One thing, here you are using in the Y14, you observe you are able to observe more than one credit card if you have them with the same bank. But given that you are also later on matching with the CCP, could you look at people that have more than one credit card account in the CCP? So it could be with different banks. So that would allow you to still do the separation without the need of having two with the same bank.
Yeah. Yes, I think that's a good idea. I think that's something we can look into later. So yeah, we were able to isolate that the liquidity constraint concerns from the Y14M, but we can also match that with the CCP data to look at another part of the liquidity constraint impacts.
Sounds good. Another question that we got here is, can this paper provide some aggregate estimate of the cost of misusing credit cards?
Can you say that again? I'm sorry.
Can this paper provide some aggregate estimate of the cost of misusing credit cards?
Misusing credit cards. So we know, so here it says, yeah, so they're like, so a year after they first used the balance transfer accounts, they're $12 more, they're like more likely to pay $12 more on finance charges. So that's not like very big amount, but it still makes people spend more due to financial lack of sophistication. So that's another thing maybe we can look into. So it's just people who use balance transfer. So and for people who have a good credit scores, but if we look at the consumers who with the subprime credit scores, the impact might be larger than that. So that's something maybe we can look into again.
Sounds good. I think we don't have any more questions at this moment, unless someone else sends something. So I don't know, maybe.
Yeah. Actually, I would like to continue. Thank you very much for these great presentations and so on. And I would like to continue the discussion about, as you have mentioned, financial sophistication can be quite expensive, or lack of financial sophistication, right? So, what can we do in a sense to maybe help people manage their credit card? And I agree with you that we need financial literacy in the schools, so that young people start using credit card. And credit cards are so ubiquitous now, right? Almost everybody uses them. But then, after people leave the school or the college, it's a little bit harder to do so. So can you tell us perhaps, what else can we do to address it? To me, your paper is such an important kind of call, to address this problem. And, how much maybe regulation versus education, if you can, given your data and given your number, what are some of the indications for that?
Yeah, I think so. Once you graduate college or graduate high school, it's really difficult to get good financial advice or financial knowledge. Unless you really voluntarily signed up for those kind of education classes. So I think what we can think of, like what I said before, I think what we can do is we can somehow promote the environment where people can discuss their options with the experts. So people cannot have all kind of information, the things that they use for their financial activities, and it's kind of impossible to educate people on everything. So when that happens, and the financial products are more complex nowadays, so it's very difficult to learn some things that people use for their life, in their life. So I think what we can offer is we can promote the environment where people can consult their financial situation and financial options with the experts. And it is very expensive for some people to afford that kind of expert service. So maybe the regulators maybe can think about ways to promote this kind of expert service by allowing subsidies for those especially for those who are for those who are old people, minorities, low income individuals, and individuals without college degree who have difficulties in getting those kind of information. I think that's something we can think about.
Yeah.
Forward.
I actually think that's very important what you said, because one of the problems of the financial advice, right? People think that financial advice is about managing wealth, right? But often it's about managing assets. It's not about managing debt. And so, we need to add that component to the financial advice, because in fact, managing debt can be very important. The problem is, as you have mentioned, that probably several of these people do not have a lot of wealth to manage, right? So they don't necessarily go to the financial advisor. And so, I think we need to think of potential, for example, other solution. And, one of the things I always thought is that the workplace can be another good place where people can discuss their finances. Also because, if you have problem with debt, right, then you can also have, maybe issues with your job, with your employment. You spend maybe a lot of hours at work worrying about this and so on. So maybe the workplace could be another kind of source of financial advice for people.
Right. And then events like this, so that people can discuss what are the options we can have, and more paper discussions like this, I think can help as well. So yeah, I thank you for this organizing this seminar and for that.
Yeah. And can you tell us more, what do you think the regulator can do more, right? The Credit Card Act was a very, very important act, right? But it was back to 2009. Given all the changes that have happened in the credit card, what do you see this as potentially another role for the regulator?
So I think credit card also is becoming more complex now. That they have buy now, pay later options. So you don't have anything, even if you don't have anything to pay right now, you can buy something, right? So so there are more options with the credit cards, and some people might have a good understanding what they're using, but some people do not have good understanding what they're using. So I think one thing we should keep in mind is, as a regulator, is we should ask credit card companies, first of all, to make everything so transparent so that people understand what they're buying. And another thing is we should ask credit card companies to make products simple. You know, it doesn't have to be so complex. So if it is simple, you don't have to make people, be vigilant about what they're buying. But then, so it's I think that's another thing maybe we can ask for credit card companies to do going forward as a regulator.
Yeah, I've always heard this call for simplifications, right? In a sense, it would be helpful, but it's very, very hard to do, right? So, and sometimes sophistication does bring advantages. I mean, I don't mean, it can also bring confusion and it can also make decisions harder. But I think this call for simplification often just falls into, into nothing, because I think it's just very hard also to impose sophistication. So maybe it's also upon us to maybe provide some suggestions or make clear that people can learn this. There is a question here that I want to read to you, and perhaps I'll partly answer as well, because, for example, Benjamin Kay says, my reading of the financial education literature is that lessons do approximately nothing for creating long-lasting informed consumer. So what's the solution? Should we simplify? Should we put caps? Should we change liabilities? So let me just say, first of all, it's not completely true. And we just finished a meta-analysis that's showing that financial education does work. So I think this idea that financial education doesn't work, I'd love to dispel a little bit more, because I think we are continuing saying that. But even the last meta-analysis that shows this in 2014. So let's update a little bit expectations and look at more recent data. But it's true that we don't have a lot of evidence on the long-term effect. So I think it is a complex problem. And I think the paper that you have mentioned today kind of really speak of, we need to educate, but we also need to find any other solutions. Maybe can you say a little bit more? Do you think like we need caps, we need other changes and so on?
Yeah, I think what you're saying is right. So there is a role that financial education can help people to make better choice. And there's another area that, even if people have a good financial knowledge, they make wrong choice because of, this behavior bias, they have less self-control, and, and there are other things like limited attention or things like that. So the financial education is not like the only, it of course helps people to make better decisions, but there are more than that. So what I'm suggesting is, we should make people we should give people a chance to compare the options they have, and compare the benefits and cost of the options they have, and then and I think, yeah, so that's something I think we should consider going forward. What can we provide consumers to make better informed decisions, in addition to the financial educations, and in addition to those kind of behavior bias that we can control with additional information. So there are lots on the financial literacy field, I think.
Well, thank you. I think that's extremely well said and extremely balanced view, right? We need to move in every direction. We need better products. Why do the products need to be, complicated with lots of rule, and also opaque and things like this? We need better regulations so that, the regulator, in a sense, prevents people from maybe paying too much, and we need education so that people can take advantage of the products in front of them. I think your paper has actually told us a lot. It's told us that there are, those mistakes that the regulator can help, and hopefully we can, do much better, because credit cards are so diffuse. This is what we use so much, and I think it's really important that we make sure that people make the best use of it. So thank you so much for being here with us today, for presenting this great paper. This is also, you have an amazing data set, and this is what the good use of data can tell us. We have a few more seminar series, so please join us again for the next seminar series. And thank you again for being here.
Thank you.
Thank you. Bye-bye.
Thank you.
Thank you.